How do you value companies with negative earnings? Imagine trying to figure out the worth of a company that is not making any profit right now. It might seem tricky, but it's a common situation, especially with startups or firms going through tough times. When a company reports negative earnings, traditional methods like the price-to-earnings ratio don't work because you can't divide by zero or a negative number and get a clear picture. So, how do investors and analysts handle this? First, it's important to understand why the earnings are negative. Sometimes it's just a temporary setback like a product recall, a strike, or a seasonal slowdown. Other times, it's because the company is investing heavily in growth, research, or expansion, which cuts into profits for now. And in some cases, the negative earnings reflected deeper, long-term issues with the business model or management. For companies with short-term negative earnings, analysts often look at normalized earnings. This means they adjust current losses by removing one-time expenses or averaging earnings over a full economic cycle. This helps estimate what the company's earnings might look like when things stabilize. For example, if a factory had a major fire that caused a big expense, removing that from the calculation can give a clearer picture of ongoing profitability. When earnings are negative over a longer period, or the company is still in an early growth phase, traditional valuation methods fall short. Instead, analysts turn to discounted cash flow models based on future cash flows. They project when the company might turn profitable and generate positive cash flows, then discount those cash flows back to today's value. This approach focuses on the potential future rather than current losses. Another method involves using revenue multiples. If the company has strong sales but no profits yet, you can compare its revenue to similar companies that are profitable. Adjustments are made based on growth prospects and risk factors. Sometimes, option pricing models are used, especially when the company has a lot of debt or uncertain prospects. These models treat equity like a call option on the company's assets, capturing the value of a potential turnaround. Scenario analysis is also common. Analysts create different possible futures, best case, worst case, and most likely, and assign probabilities to each. This helps in understanding the range of possible values and risks involved. For traders and options investors, negative earnings often mean higher risk and more volatility. They might buy put options to protect against a decline or call options if they believe the company will turn around. Implied volatility in options prices often reflects market uncertainty about the company's future. In the end, valuing a company with negative earnings is about shifting focus from current profits to future potential. It's about normalizing earnings when possible, using alternative valuation methods, and understanding the risks involved. This approach helps investors make smarter decisions, even when the company isn't profitable today.